Hey, this is Daniel Neesmith, President and CEO of Security First Asset Management. I hope everyone is having a great summer and a great first half of the year. I just wanted to give you a little mid-year update on our portfolios and tell you about what's going on in the economy. First of all, a quick announcement. We're going to be having what we call our halftime report. Again, this year we're going to have it at Pinstripes Bowling Alley. It's going to be right here close to our Macon office on Sheridan Drive. That's August 9th. We had a great time last year. I believe there was over 50 people there. And we've got some great bowlers in our group. So come out August 9th, and I'm going to do a halftime report and tell you about a little more in detail about what's going on with the economy. Now, the first half of the year, as you know, has been very volatile. The markets have been swinging both up and down. We had first quarter GDP that was negative. They revised it for a third and final time, and now our GDP for the first quarter of 2025 looks like it's going to come in at negative 0.5%. Now, the risk factors have become more elevated this year. Last year, we had a really smooth year. Markets were pretty strong. This year, there's some factors that are making things a little bit more complicated. Tariffs, for example, make it difficult for corporations to know how to invest their capital. They don't know the input costs of raw materials. For example, copper, a new 50% tariff has just been put on copper. So we have to be aware when risk environments are heightened that there's going to be more volatility in the market. These are the 20 leading economic indicators that are published by City National Rockdale. It's a company that I've been using for research and data for many, many years. The three most important leading indicators, in my opinion, are the labor market, consumer spending, and corporate profit growth. Now, all three of those have become neutral in the last 4 months. Starting out this year, they were all positive, meaning it was forecasted corporate profits would grow 12 to 15%. Those have been revised downwards. In February, we made the decision in our low and moderate risk portfolios to reduce equity exposure to 50%. That's a serious move, but our job is to manage downside risk when times are more volatile and when there's factors that show markets could go negative. So we did that in February. We didn't experience the volatility of the S&P or the downside. Now, on our low and moderate risk portfolios, we manage downside risk. Our growth portfolio, we do not get in and out of the market. We don't do it very often, even in the low and moderate risk portfolios. I believe it's only happened 3 times since 2016, since I started managing our portfolio. So we have reduced risk, and it has helped us to maintain smoother returns and less downside than what we've seen in the S&P 500. So we recently did change 2 securities. We exited the position for General Mills and also Paychex. The reason for that is there was some factors with General Mills with the new regulations for healthier foods and things like that that were making investors afraid of that stock, and Paychex became overvalued. So it's our job to make sure you stay on track, and we automatically make changes to your equities in your portfolio when time makes it necessary to do so. So we're going to go into more depth about this August 9th at Pinstripes Bowling Alley. Please come and see us. I really hope that markets will calm down over the next 3 to 6 months. But as I tell my clients, it's our job to protect your money in uncertain years, and it's our job to grow your money more in years like last year. So we all hope that markets return to normality, but until then, we're going to be more cautious. So look forward to seeing you soon, and you guys have a great summer. Enjoy your families, and take care.